everyone. Thank you for joining us once again here at Seafood and Brew for our weekly briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we want to go over the fourth quarter performance of our community bank benchmark. As you know, we do a lot of analysis for institutions on performance as well as risk. And what we want to do is focus on just the fourth quarter here and look at the performance aspect without looking at risk. Overall, the risk really hasn't changed that much from prior quarters, so we're going to skip over that today, but look at the risk, look at the return and the performance. ROA, what we saw this quarter, not a big surprise. We saw a pretty significant downturn in the performance in terms of ROA, and that primarily is due to the new tax law that was signed into effect in December. That kind of pushed through those adjustments to deferred tax assets and resulted in a higher level of overall tax expense for that accounting. So when we look at that, we saw a pretty significant decline in the ROA. And we could see the level of impact by looking at the pre-tax return on average assets actually only went down from a 134 to a 123, much of a smaller reduction compared to the overall return on assets from a 103 to 75 basis points. But overall, when we look at net interest margin, we did see a slight uptick in net interest margin from that 381 to a 382. So that's a positive in here. A lot of this is built off of the fact that we haven't had to reprice those core deposits yet. And that's something that I believe by the end of the year, we're going to be working through some of those core deposits and needing to increase those rates. When we look at the components of net interest margin, we can see the yielding earning assets, pretty significant increase. We got a 20 basis point increase from the first quarter of 2017 through that fourth quarter of 2017. While on the cost of funds side, going from 44 basis points only up to 52. So we saw an increase of that 8 basis points, but not near the amount we saw increase in the yielding earning assets. However, we did see it kind of pull off that growth trajectory just a little bit on the yielding earning assets, and cost of funds picked up that 2 basis points. This is going to be the big question here throughout 2018. If we continue to see the Fed increase rates 3 times as they anticipate, we're going to begin to see this start to creep up. And the ALCO committees and the boards that I see every quarter, we're starting to hear more and more that those core deposit customers are coming in for rate adjustments. We've seen it throughout 2017, beginning in the second quarter on the CD side, and now we're starting to see that filtrate into those core cash type deposits. So we'll see throughout this year. My anticipation is that by the end of the year, I would not be surprised if we saw the cost of interest-bearing deposits increase to 80 basis points. Looking at the level of cash type deposits to total deposits, you can see in the first and second quarters really didn't have much movement, even in the third quarter, but in the fourth quarter we picked up a little bit, up to 72.65. Over the past 5 years, this number has continually grown, and that was a result of just money coming out of the stock market and being parked in the money market and savings accounts at banks. The question is will this money start to flow out? We haven't seen that happen too significantly at most of our institutions, but that is a risk and a liquidity sensitivity that you should be testing in your ALCO reports. Overall, when we look at the yield curve, the impact here throughout 2018 will be significant. As you know, the 10-year Treasury has started to pick up. This was as of the 15th. We're now at the 10-year Treasury at that 2.9 mark. And you can see the difference between the end of year and where we are now, these two curves. We saw that play throughout 2018, the increase on the short end of the curve, or 2017 on the short end of the curve, and now we're starting to see that upward trend on the long end. This should help our asset yields, and it should overall help our net interest margin. However, we do anticipate a continual tightening of the curve. The slope continues to get flat, and if you look at the forward curves, they continue to become flatter and flatter out 2-3 years. In fact, out 3 years, I believe the spread between the 10-year and 2 years now down to about 20 basis points. So a very flat curve anticipated. When we look at the net overhead for institutions, you can see we had a pretty significant increase in the fourth quarter here from that 207 up to a 215. This net overhead is the difference between non-interest expense and non-interest income. So when we look at the difference between the two, we can see obviously that increase was due to the expenses, most likely just typical year-end expenses coming in, as well as maybe some adjustments for the tax side as well. So we need to keep that in consideration. Anticipate this to come back down in the fourth quarter results. So that's what we have for you this week. Next week, we're going to look at the inflation numbers that have been coming out. We're starting to see some pickup in inflation a little bit by a little bit, but the question is this what's leading into potentially the increase in that long end of the curve based off of the inflation expectations? So we look forward to seeing you back here next week. Have a great week, everyone.